Welcome to Echo Trade. This is Jeff Roth. Today we're here with Bill and Shirley from Garrison Bradford, and we're talking about their portfolio long-term wealth builders offered in Echo Trade. So Bill, Shirley, appreciate you guys being here and taking some time.
Thanks, Jeff.
You're welcome.
So I want to dive into the portfolio, but quick, I'll give a little bit of background on you guys. So Bill has a long 10-year track record in portfolio management. I think 40 years almost at Garrison Bradford alone, and a decade or two before that, at several other companies. He was one of the first CFA charter holders, managed hundreds and hundreds of millions of dollars over his career, and Shirley has been in finance for her entire career. She has global experience. She's a chartered accountant in New Zealand, and had time at J.P. Morgan Chase, and has been with Bill and Garrison Bradford for over a decade. So we're lucky to have you guys on the platform. But today, let's dive into the portfolio, long-term wealth builders. So give me just kind of a general thesis of the portfolio. What's the overall objective of the long-term wealth builders portfolio?
Well, it's a long-only stock strategy. The goal is long-term growth at a risk level that's moderate compared to the risk level in the stock market in general.
Yeah, gotcha. So what's you're talking about? It's a moderate risk level relative to equity, exposure in general. What are you guys doing to actually kind of manage that risk? How do you define that?
Well, a lot, Jeff, has to do with the kind of stocks that we own. So we are from over many decades of experience. I've come to be an unapologetic believer in the power of compounding earnings and sales growth that gets delivered by truly great growth companies. We've done a lot of research on this. I'm absolutely convinced that if you can find a company that pretty consistently grows its sales and earnings at a somewhat above average rate, it doesn't have to be terrifically high growth, but just consistently above average, that the chances are that this stock is going to outperform the stock market. The chances are extremely high, and for that reason, I think this kind of great growth company is, it's the greatest wealth building machine ever invented.
So how do you define then? Oh, sorry. Go ahead, Shirley. Sorry.
I would like to add to that, especially to answer your risk management question. The fact that we expend a lot of effort to finding these great growth companies who will be dominant leaders in its field, in itself, is managing risk at its source.
Yeah.
The whole reason being, if these are the leaders of these dominant large market places, then if the stock market falls, the tendency of the stock price to fall less than the market is great. So you capture on the upside, you actually capture the risk on the less risk on the downside. And the power of these two interaction propels the overall return of the companies compounded over time. So not only is it great total return, that's why you have moderate risk relative to the stock market.
So moderate risk because of the companies you guys are investing in. So talk more about, your definition of these growth companies. Define that for the audience. What to you guys is a growth company?
Well, it's easy to say that great growth companies outperform over the long term. The problem, of course, is how do you find them?
Yeah.
So we think there are three sort of common characteristics that they all have, and the first is that it's a great business. There's something about the business that makes the company unique. Warren Buffett calls this a moat, but it's something that gives the company protection from competition. It gives them pricing power. It lets them control their own destiny rather than being ruled by competitive or cyclical economic factors in their in their industry. So that's all of these companies share that. It doesn't matter the industry. So the second factor is that the market available to them is big.
Yeah.
So that there's a sort of an unlimited roadway for growth. And as I say, if you invent the iPhone, that's great. And if you, as an investor, found that early on, that's great. But there are enormous other markets. Some of them, are growth industries, health and technology and so forth. But there are other mature markets that are just that offer just as much opportunity if your business model is disruptive and you're taking significant market share. And then the third factor is management. It in many cases it's the management that built this great company, but not always. But the characteristic I think that all of these companies has is the management thinks like owners of the business. They're entrepreneurial.
Yeah.
They understand risk. They're willing to take risk, but it's sensible risk. The same kind of risk that you would take with your own company. You want to see your company grow. You want to see the value of the company increase, but you also don't want to bet the whole company on any single project. So it's those three characteristics that show up in every company when you look back 10 years and see that their sales and earnings not only grew faster than average, but did it relatively consistently, because it's that consistency that allows for the compounding in the long run.
So I would like to add a really recent example. So exciting to see this in real time. Of course, everybody knows about Twitter and Facebook, and of course the recent spat between Elon Musk and Zuckerberg. So it has heightened to such a level that Zuckerberg, Facebook said, okay, I'm going to show you. And very quickly, they developed an app called Threads. So within 2 weeks, they garnered 100 million users, which took Twitter months, and then in fact, more than months, almost a year or so to acquire. That is the power that we mentioned when we say competitive edge, a moat. Facebook just launched a product and they got so many subscribers, users in a short space of time. So we look for companies with that potential and that power.
So I'm glad you used that example, because I was going to ask, you're talking about, competitive advantage, competitive protection and looking at, entrepreneurial ownership, but are there any kind of quantitative factors that you guys are looking at to define or to determine companies that have those characteristics that you're looking for?
Well, not really. We're not screening databases or universes. We've been at this for a long time. We're aware of companies that are around. Of course, new companies come up and so forth. But financially, the characteristics of a great growth company are better than average sales and earnings, a relatively high R square to their consistency, to their growth, a strong balance sheet that's generally self-funding, so not a lot of leverage and high returns on invested capital. That's that's what comes from being able to fund your own growth. The growth is better than average.
And
So-
also it's an art because you are looking into the future. You are trying to discern based on what is currently available information to you to see, will this company has the ability to grow its market share? And is this market large enough? And therefore, you marry all these soft data points and arrive at that decision to say, okay, what is the ability of this company to earn 5-10 years from now? I remember we had this conversation on Amazon. This is 5 years ago, before the stock split. And then it was trading around $400, $500. And we were saying, let's look at this. And I remember saying, Amazon at that point is to me like an octopus. It has its tentacles in every major aspect of a person's life.
Absolutely.
And when you go into that space, it sucks the air out. And we arrived at a valuation at $3,000. And we said, let's buy it.
Well,
and it happened. It was at $3,000 before it split.
Yeah. Mm-hmm.
Yeah. So we think about the numbers, if you will, a little bit differently, because we're not following. Of course, you're watching because you're monitoring what management is doing, but we're not following the earnings estimates or responding to estimates being raised so much as what we're trying to think out 2 or 3 years to what sort of an average earnings level might be. In the case of Amazon, they're not making any money on their business, which is
for years and years and years,
which is a retail business and delivering goods. But when they get when they get to that point of beginning to make money, what might the earnings level look like then? Then you add in, we bought Amazon basically when Amazon began to separate out, wrong grammar, began to separate Amazon Web Services and show that as a separate company. You could see how profitable it was. And there are other businesses like that in Amazon, advertising and so forth. So you can put together sort of a picture as these things all continue to grow or begin to produce the level of profitability that they're capable of, out a couple of years. So you come up with some sort of an average earnings level out there. You think, you try to think through what would the market be paying for that at that point in terms of the growth characteristics, what other companies in that industry are selling for, and you come up with a fair price. It's the simple concept of a margin of safety. What would I pay for that today?
Mm-hmm.
And depending on the level of risk involved, and of course, since a lot of this in the case of Amazon hadn't developed yet, you have to make the margin of safety pretty big. But as Shirley suggests, the numbers, when you actually think about how profitable this could be, the numbers suggested that an average market multiple on those earnings out a few years could result in a tripling or doubling or quadrupling of the stock price.
Gotcha. So are you guys looking for any defined, return over that couple of years that you're looking out to make the determination that this is a good purchase at this point? But obviously, and it goes into time horizon as well. You guys are clearly looking at least 2 to 3 years into the future, and you want to hold on to the position for that amount of time. Is that correct?
Yes, that's what I think really differentiates us from a lot of other analysts. I am sorry to say that if you follow any analysts of any major institutions, they always say, oh, we are upgrading the stock price to this level, when in fact it is already trading at this level. That is useless information, right? What we do, we are security analysts. We scout, we identify, we try our darnest best to look at what each company has to offer. Can the management deliver? Is there any distinct advantage of this company? And then we think about the future growth potential. Can this company achieve this future growth potential? And if the market doesn't know of this company, is even better because they are so undervalued. Nobody's buying it. So when they finally, in 2-3 years, manifest that real potential in terms of actual dollars and cents in earnings, and now everybody is so high about, oh, like NVIDIA, it's amazing. 12 months ago, NVIDIA was crashed, treated like a dog, from $250 to $80. Why? Because, they have too much inventory in the channel. And guess what? NVIDIA is now $450 because they say we make AI chips. So you must have the capacity and ability to understand all these various nuances before the market understand them.
Well, and Jeff, the short answer to your question really is, we're hoping to hold the stock for forever.
Yeah.
Our sell discipline isn't really precise. It's you sell when the story, what you thought was the long-term story, when you begin to question that, it's time to get out. We owned PayPal for years and made a ton of money, and we didn't sell anywhere close to the top, but we still made a ton of money. But we began to realize that what we thought was a moat wasn't. That there were a lot of ways to for the enemy to attack them.
Yeah.
And also Alibaba, we made money on Alibaba until they pulled the rug of Jack Ma and questioned me. And I said, no, before they actually questioned Jack Ma, they did something. They changed the regulation. And I told Bill, I said, look, you don't fight with the Chinese government. And we got out at a handsome profit. We never looked back because, it crashed and burned for a long time.
But the longer you hold the in terms of compounding, the better you're going to do. The example I love, just arithmetically, is that 10% gains in a row produces a return that's double the return you'll get if it goes up 25%, goes down 25%, and then goes back up 25%. You don't have to hit home runs.
Yeah.
You just have to find something that keeps doing it successfully year after year.
And you have to minimize the risk on the losers. And I'm glad you kind of brought that up with what your sell discipline looks like, because I was going to ask, how do you manage and minimize the risk when, like you said, when the story that you thought you were, seeing no longer is actually the case, or you don't believe it to be the case. So thanks for diving into that. I didn't have to ask. I guess finally, to wrap it up, can you talk about, just for the investors, I always like to ask, how do you see this portfolio, a little bit different than what's available, within the wider industry? How do you see kind of your viewpoint a little bit differently?
Well,
we are concentrated portfolio managers. In our Echo trading platform, we own currently 11 stocks. Our intention is to own between 10 to 15 stocks in the long haul, and essentially let these great companies do its thing. We ride their performance, and we let the compounding work for us. We do not use ETFs. We do not that because they don't do well, they do well, but why would you dilute the performance of these great companies with 95% of less good companies. It doesn't seem logical.
Thank you, guys. Bill, if you want to tap it off.
No, I was just going to say that I think in practice, having run money for a long time, that this is maybe one of the easier strategies to pursue, because there aren't as many decision points along the way. You have to know what you're looking for. You have to be able to find it. You have to be patient enough to wait till the stock sells at an attractive discount from what you think the fair value is. But you don't have to make a lot of other decisions along the way until it gets to the point where you see it's over and you've got to sell. But if your strategy involves timing the stock market or making decisions based on your or somebody else's forecast of the economy, or rotating between industry groups or large caps or small caps or value or growth, you've got to be right on a lot of those. You've got to be right going in. You've got to be right going out.
There are so many multitude points of decisions.
I think it's not saying that this is easy at all, and everybody makes mistakes, and we've done a fair amount of analysis of our record over time, and you're not going to be surprised that 80% of the long-term outperformance comes from a relatively narrow group of stocks. If you own 15 stocks, if 10 of them are going to do more or less what the stock market does. If you're good, you'll do a little better than the market with those. But the real long-term performance comes from what the 5 outliers do.
Yeah.
And long-term performance is built by recognizing when you've got a real winner and letting it run. Not losing your nerve and selling too soon. And on the other side, you've got to be honest with yourself. You've got to admit when you make a mistake, and you have to sell before it really starts to hurt you.
And that part takes a lot of discipline. Admit your error and sell before they hurt.
I was going to say that's usually the hardest part. It's easy to get in, but it's hard to figure out when to get out. Yeah. So I appreciate you guys. It's always great to hear different perspectives, and it's hard to argue with the amount of experience on your guys' side of the table. But I appreciate you guys taking the time, and investors can learn more and they can subscribe and get access to the long-term wealth builders portfolio within EchoTrade. So Bill, Shirley, thanks for being here.
Great.
Pleasure.
Thanks, Jeff.
Thank you.